You are listening to The Vocal Technologist. Spoken tech for your ears.
I mean, I want you to imagine a scenario that sounds slightly absurd.
Okay, I am listening.
It sounds maybe even like science fiction, but it is actually happening. Picture picking up your phone and just, sending a casual text message to your bank.
Right.
You tell them to freeze your credit card, run a cash flow forecast for the next 6 months, and model out a retirement plan based on your current savings rate.
Just all in one go.
All in one breath. And the bank actually does it instantly.
Oh, wow.
Yeah, there are no drop-down menus, no clunky dashboards, no waiting on hold for a representative, just a simple conversation, and the math is perfectly executed in the background.
It sounds like a massive leap from the banking applications most of us are used to. I mean, we have been conditioned over the last 2 decades to accept that managing money means clicking through endless tabs.
Oh, absolutely.
Downloading spreadsheets, and trying to decipher bar charts on our own.
We are so used to the friction that we do not even see it anymore. Well, for this Founder Fridays edition of Vocal Technologist, our mission is to pull apart the latest material on financial technology and really look completely under the hood.
Brilliant.
As your resident tech-savvy mate, I promise we are going to explore how artificial intelligence and entirely new infrastructure are, completely rewiring how money moves. And honestly, the sheer speed of this transformation made me do a double take.
Spot on. This shift is fundamental. We are moving away from pointing and clicking and heading straight into natural language conversations.
Right.
The interface for managing wealth is becoming completely conversational, which alters the entire relationship between you and your capital.
Which brings us to the first massive development. Perplexity has introduced a personal finance hub.
This is a big deal.
It is huge, and they have integrated directly with Plaid. For anyone unfamiliar, Plaid is the digital pipe that connects financial applications to your actual bank. So this means Perplexity connects your bank accounts, your credit cards, your loans, and your investments all in one single place. You can just ask it questions to analyze your full financial picture.
It is genuinely impressive.
Yeah, it generates net worth trackers and custom budget models just from you typing a normal sentence. I have to say, it is like moving from trying to decipher a confusing map on your own in the dark to having a brilliant local guide sitting in the passenger seat who just tells you exactly where to turn.
That is a great way to put it.
I am genuinely surprised Perplexity is moving beyond general search and plugging straight into Plaid like this.
Well, it is a brilliant strategic move, but to understand why they are doing it, we need to look at the underlying mechanics of the technology sector.
Okay, unpack that for me.
If anyone can build a smart chatbot, the technology itself stops being special. I mean, when traditional software gets commoditized by large language models, the only real protective barriers left for companies are proprietary data and workflow ownership.
Right, so you are saying that if the intelligence is essentially free and ubiquitous, the winner is the company that actually holds your transaction history.
Yes, exactly.
And the one that has the permission to execute tasks on your behalf.
Precisely. By integrating with Plaid, Perplexity is not just giving you generic financial advice scraped from the internet. They are analyzing your actual real-time financial reality.
That makes total sense.
And Revolut is moving in a very similar direction. They are rolling out a conversational artificial intelligence tool that lets users get spending insights, manage subscriptions, and even plan trips entirely via chat.
Wow, so it just removes the need for a traditional user interface almost entirely.
Pretty much.
And if we look beyond just consumer-facing applications, even the back-end payment processing is getting conversational. There's a company called Lovable introducing a conversational payment stack.
Right, I saw that.
Yeah, they're calling it a Stripe Plus support layer. You basically manage your tax compliance and currency conversions through natural language rather than writing complex code or integrating heavy application programming interfaces.
It sounds incredibly efficient.
It does, but wait, I need to pause here because I see a massive red flag.
Wait, what is that?
If we are handing over tax compliance and complex financial modeling to artificial intelligence, how does that actually work? Because, large language models are notoriously bad at basic arithmetic.
Spot on. That is the critical technical hurdle.
Right.
It is important to understand why they struggle with math. Large language models are probabilistic engines. They are essentially highly advanced prediction machines guessing the next most logical word in a sentence based on massive amounts of training data.
So they're not actually doing the math.
Exactly. They do not natively calculate compounding interest or currency fluctuations with the absolute deterministic precision required for finance.
Ah,
A calculator knows that 2 plus 2 equals 4 because of rigid rules. A language model guesses the answer is 4 because those words frequently appear together in its training data.
that makes giving an artificial intelligence complete control over your tax calculations sound incredibly risky. I mean, if it hallucinates a tax code or misplaces a decimal point in a currency conversion, the user is the one dealing with the revenue service, not the chatbot.
Which is exactly why OpenAI just acquired Harrow Finance.
Oh, wait, really?
Yeah. Harrow was founded by Ethan Block, the former chief executive officer of Digit, and they specifically built tools to model personal financial scenarios with high mathematical accuracy.
Oh, I see. So OpenAI is bringing in a team to build a deterministic math engine under the hood of their probabilistic language model.
Yes. OpenAI absorbing that team's signals, they know they need domain expertise and precise financial math to expand into these high-stakes use cases.
They cannot just fake it.
Exactly. They cannot rely on language prediction for banking. They need a dedicated financial calculator running quietly in the background of the conversation.
Okay, so on the front end, we get these brilliant, friendly financial co-pilots managing our budgets with perfect math.
Right.
But if we transition from personal finances to institutional banking, here is where it gets properly weird. If artificial intelligence is managing our money on the consumer side, what happens when an entire corporation tries to plug their enterprise systems into it?
It gets complicated very quickly.
Because while we get fancy chatbots, Wall Street is quietly preparing for absolute digital warfare.
The security implications of all this automated finance are just staggering. When you make systems more interconnected and responsive to natural language, you also open up entirely new vectors for cyber attacks.
You're basically giving an automated system the keys to the kingdom.
You really are.
And the regulators are incredibly stressed about it. Major banks, we are talking JP Morgan, Goldman Sachs, and Citigroup, are currently testing Anthropic's Mythos model under something called Project Glasswing.
Yes, I read the briefings on that.
Right. The goal is to identify and exploit system vulnerabilities. U.S. financial leaders, including Bessent and Powell, actually held urgent briefings with bank executives about this exact model.
Because of its capabilities.
Yeah, apparently this model can exploit vulnerabilities across different operating systems and browsers with terrifying efficiency. So the regulators are basically telling banks to hire artificial intelligence to hack themselves before someone else does.
It is proactive defense.
Which, yeah, is exactly as terrifying as it sounds. I mean, it is like installing a state-of-the-art smart lock on your front door, feeling completely secure, only to realize the burglars now have quantum computers that can pick it in 3 seconds.
That is a perfect way to visualize it. And to carry that forward, if you do not constantly upgrade that smart lock to anticipate the burglar's next tool, your entire house is compromised.
So it never ends.
No, this is a literal cyber arms race.
Hmm.
You have to understand that this is not just about making banking applications run faster. It is about protecting critical financial infrastructure.
Because the stakes are so high.
Exactly. The reason the government is stepping in for these briefings is that a model capable of autonomous exploitation could bring down clearinghouses or payment networks if it falls into the wrong hands. Banks are being forced to deploy their capital into defensive technology just to survive.
But proving the value of that technology is something the entire tech sector is struggling with right now. I'm looking at the Silicon Valley Bank report regarding software companies and stock-based compensation, and I am a bit lost.
Okay, let us pull that apart.
For a decade, handing out equity was essentially free money. Why is the bill suddenly coming due right at the exact moment artificial intelligence is disrupting these companies?
To understand that, you have to look at the macroeconomic environment. We just exited an era of zero interest rate policy.
Right.
For years, money was incredibly cheap to borrow, so investors poured capital into software companies, which inflated their valuations. Because valuations were so high, companies could hand out restricted stock units to employees instead of cash.
And everyone was thrilled with that.
Spot on. The employees were happy because the stock kept going up, and the companies were happy because they kept their cash reserves high.
But then inflation hit, interest rates went up, and the cheap money vanished.
Correct. And simultaneously, artificial intelligence began automating the very tasks those software companies charged premium prices for. So valuations dropped significantly.
Oh, I see.
Suddenly, those restricted stock units are feeling like massive pay cuts to employees. For a long time, the industry treated stock-based compensation as a non-economic expense. You would look at an earnings report and companies would add that expense back to make their profit margins look better.
But you cannot do that forever.
No. When valuations drop, the dilution hits the shareholders, and the employees realize their equity is worth a fraction of what they expected.
So companies are now being forced to treat stock-based compensation as a true operating expense.
Yes, it is a direct result of the pressure to show genuine return on investment in a tighter economic environment. You see this reflected in how major institutions are spending money too.
Like who?
Bank of America is a great example. They are shifting away from isolated, flashy experiments and moving toward large-scale operational change. They are focusing heavily on measurable returns and building reusable systems, primarily expanding their Erica assistant.
They want real business impact, not just cool demonstrations.
Exactly.
So the software inside the banks is changing, the security protocols are changing, and the corporate accounting is facing a massive reality check. But hang on, we also need to talk about the physical pipes connecting all of this together.
The underlying infrastructure.
Yeah, the very plumbing of global finance is being ripped out and replaced, and the biggest shocker here is SWIFT.
The infrastructure that settles transactions between nations is undergoing its most significant upgrade in decades.
Okay, before we go further, I need to stop you there. SWIFT is rolling out a shared ledger built on an Ethereum virtual machine compatible stack for real-time cross-border transactions using tokenized deposits.
I know, it's a mouthful.
That is a massive string of technical terms. Just so we are totally clear on the mechanics, how does a tokenized deposit actually differ from the numbers I see in my bank account right now?
That is the crucial distinction. Currently, the money in your bank account is just a database entry. If you want to send money internationally, your bank has to send a message to a correspondent bank,
Right.
which updates its database and then sends another message to the destination bank. It is slow, it requires manual reconciliation, and it operates only during business hours.
It sounds incredibly old school.
It is. A tokenized deposit, however, turns that database entry into a programmable digital asset on a shared ledger.
So instead of sending a message asking another bank to move money, the money itself is a piece of code that physically moves across the network instantly.
Exactly. It operates via a smart contract.
Right.
An Ethereum virtual machine compatible stack simply means Swift is using the underlying architecture of the Ethereum network, which allows for these programmable contracts to execute automatically when certain conditions are met.
But SWIFT is the ultimate 50-year-old incumbent banking system. Why on earth are they suddenly adopting blockchain?
Because they have to.
It feels like trying to replace all the copper pipes in a massive skyscraper while the water is still running at full blast.
That is a brilliant analogy. But if they do not replace those copper pipes with modern fiber optics right now, tenants are just going to move to a different building.
Which in this case is the blockchain.
Precisely. The traditional correspondent banking system is just too slow and opaque for the modern economy. By creating this programmable layer, Swift allows traditional banks to interact seamlessly with digital assets while maintaining enterprise-grade control.
They're trying to stay relevant.
If they do not modernize to offer real-time settlement, alternative networks will simply bypass them entirely.
And we are seeing those alternative networks light up everywhere, driven by this desperate need for speed. The Federal Reserve Board just proposed opening its FedNow real-time payment system to intermediaries.
Yes, that is a huge development.
It would allow for international cross-border payments. They are trying to speed up the U.S. dollar system to remain competitive. Meanwhile, traditional finance is just swallowing crypto whole.
Completely.
Morgan Stanley just launched the lowest fee spot Bitcoin exchange-traded fund on the market. They priced it at a 0.14% fee, basically undercutting BlackRock. And it drew over $33 million on its very first day.
The scale of that absorption is remarkable. The broader spot Bitcoin exchange-traded fund market now holds over $85 billion.
That is wild.
It is. What we're witnessing is traditional finance completely integrating digital asset infrastructure. It is no longer a fringe asset class. It is becoming a core component of institutional portfolios because it offers a speed and efficiency the old copper pipes simply cannot match.
But the underlying technology of crypto is still being used exactly as it was originally intended on the geopolitical stage.
Very true.
Which brings us to the neutrality aspect of all this plumbing. Governments are using it when the traditional global dollar system experiences friction. We are seeing reports that Iran is demanding crypto as toll fees for ships crossing the Strait of Hormuz.
It is important to view these events through a strictly structural lens. What we're seeing is governments utilizing decentralized networks as a neutral settlement layer.
Right.
The traditional correspondent banking system requires trusted intermediaries, which are usually aligned with Western financial institutions. Decentralized networks just require cryptographic proof.
So it bypasses the need for political trust altogether.
Yes, we see a similar dynamic with Russia developing a ruble-backed stablecoin to navigate trade restrictions. And then on the other side, Ukraine has raised massive amounts of international aid through crypto donations.
So it works for whoever needs it.
Exactly. Regardless of the political motivations of the actors involved, the technology is functioning precisely as a neutral alternative financial rail when the primary systems are restricted.
It is literally a parallel plumbing system. And even on the domestic front, the plumbing for everyday merchants is getting completely overhauled.
How so?
Well, Payobbly is a company scaling its embedded payments infrastructure to nearly 100,000 merchants. They integrated with Huntington Bank to basically act as the invisible backend for money movement.
Oh, I see.
So whether it is a massive international trade settlement or just the local coffee shop processing a payment, the infrastructure is being totally rewired to run faster and cheaper. This directly impacts you, the listener, because faster settlement means fewer fees extracted by middlemen and better cash flow for the businesses you interact with every day.
And that hyper-efficiency brings us to the most complex part of this entire discussion.
The human element.
Yes, when you remove friction, automate the math, and streamline the plumbing, you also fundamentally alter the labor market. We have to examine the human cost and the macroeconomic fallout of these structural shifts.
Right, because hyper-efficiency usually means someone loses their job.
Sadly, yes.
And we are seeing it happen. Bolt, the checkout technology company, just cut 30% of its staff. They are pivoting toward an artificial intelligence-first operating model under their returning chief executive officer, Ryan Breslow.
That was a severe cut.
Massive. And this comes after their valuation absolutely cratered from $11 billion down to as low as $300 million.
The Bolt situation is a perfect microcosm of the broader enterprise software squeeze we discussed earlier.
Yep.
They have to cut costs drastically to survive, and automation provides the mechanism to do exactly that. And the data backs this up across the entire industry. That same report from Silicon Valley Bank noted that 51% of venture-backed chief financial officers are already seeing a tangible return on investment from artificial intelligence.
But here is the interesting nuance in that report.
Let's hear it.
35% of those companies are actively reducing junior roles, yet only 5% have actually implemented layoffs so far. How does that math work? I mean, if 35% are reducing roles, why are only 5% doing layoffs?
It happens through natural attrition and hiring freezes. Companies simply stop hiring entry-level workers.
Oh, I see.
The tasks those junior employees used to do, basic data entry, preliminary financial analysis, and drafting boilerplate code, are now performed instantly by the conversational interfaces we talked about at the beginning.
Wow.
The junior analyst role is evaporating. The 5% layoff figure shows that companies are trying to avoid massive restructuring headlines, but the shift in the talent mix is undeniable.
So it is just a quiet reduction.
Yes. The erosion of labor income is no longer a theoretical debate for academics. It is an active, aggressive line item in corporate boardrooms.
Which leads to perhaps the most ironic development in this entire space. OpenAI, the very company building the technology that automates these exact jobs, is publicly calling for taxes on artificial intelligence-driven automation to protect public safety nets.
That did catch a lot of attention.
I mean, they are suggesting taxes on automated labor, capital gains, and corporate profits. I have to say, it is a bit rich. So the company building the tech that automates the jobs is suggesting we tax the automation while fully acknowledging they stand to benefit from the exact system they are reshaping.
It certainly raises questions about their motivations. However, looking at the macroeconomic reality, their framework identifies a looming structural shift.
How do you mean?
Well, if automated systems capture the vast majority of economic productivity, the traditional model of taxing human income to fund social safety nets simply breaks down.
Because there is no human income to tax.
Exactly. You cannot tax a robot's income. You have to tax the capital and the computational power because that is where the value is being generated.
Wow. It feels like everyone is rushing to secure the next generation of capital. I mean, the U.S. Treasury just awarded a massive contract to Robinhood and BNY Mellon to power the Trump Accounts investing program for children.
That is a fascinating initiative.
It really is. It has already attracted over 4 million signups. The government is funding a $1,000 seed investment for eligible kids, restricting the portfolios to low-cost U.S. index funds until they reach adulthood.
That is an incredibly powerful customer acquisition funnel. By embedding early investing into a national program, Robinhood and BNY Mellon are positioning themselves at the very center of long-term financial habit formation.
We get them from day one.
Yes, they are capturing the wealth management relationship from childhood.
It is brilliant strategy, you have to admit. Get them into the ecosystem early, and as they grow, the automated assistants will just manage the money for them in the background, executing those complex financial calculations seamlessly.
Exactly.
We have covered a massive amount of ground here, from chat interfaces doing your personal taxes, to Wall Street testing cyber weapons, to the literal rewriting of global payment pipes using programmable money.
All of these developments point to a financial system that operates continuously, autonomously, and with unprecedented efficiency. The mechanisms driving your wealth are no longer static spreadsheets. They are dynamic, intelligent systems.
But it leaves us with one massive lingering question. If artificial intelligence ends up managing your personal wealth, running the global banking plumbing, and defending the very institutions holding your money, who is actually in control of your financial future? Something to chew on until the next time we get into it on Vocal Technologists. Catch you then, mate.
Spoken Tech for your ears.